Good evening, everyone. A very warm welcome to all of you to this special session on Integrated Business Solution paper organized by Board of Studies Academic. Today, we will take you through some quick insights into the airline industry, which is one of the most dynamic and strategically complex sector, especially in India. Air travel here is not just a means of transportation, it is connectivity, aspiration, and a driver of economic growth. Globally, the aviation industry is valued at over $850 billion, and India is among the fastest growing aviation market at global level. Growth is driven by rising middle class income, regional connectivity, and increasing affordability of air travel. What is equally interesting is the shift we are seeing from traditional full service carrier to low cost airlines that appeal strongly to cost conscious travelers. There are three important key trends we are going to highlight here. First, first is digitalization. Customers today prefer mobile bookings, self check-in, AI-driven chatbots, and real-time flight updates. Digital innovation is redefining passenger experience, loyalty management, and operational efficiency. Shift to low cost models, carriers like Indigo Airlines, Akasa Air, SpiceJet have expanded aggressively by offering affordable fares and high frequency routes, challenging full service players. Global partnership and alliances are very important in this industry. Airlines are increasingly joining code sharing agreements and strategic alliance to expand their international reach without adding too many new aircrafts. For example, Air India's membership in Star Alliance allows it to offer passengers access to a wider global network, improving connectivity and competitiveness. To understand how strategy works in practice, let us look at Southwest Airlines in the US. It is pioneered the low-cost carrier model, keeping operations simple. Only one type of aircraft, that is Boeing 737. Quick turnaround times at airport, no frill services, and a strong culture of employee engagement. By focusing relentlessly on cost efficiency and customer satisfaction, Southwest Airlines became consistently profitable in an industry where bankruptcies are very common. Its model its model has inspired low cost carriers at global level, even in India also. Another important case comes from Qantas Airways. Qantas, Qanta, Qantas is one of the airlines which links its CEO's compensation directly with balanced scorecard. Balanced scorecard, which we are going to discuss in today's session. Instead of paying bonuses purely on financial metrics, Qantas tied executive rewards to balanced mix of various factors like financial performance. It is connected with the revenue growth, cost reduction, shareholder returns, customer satisfaction. It is connected with loyalty scores, on time performance, operational excellence. It is connected with safety, fuel efficiency, reliability, and people and culture. It is connected with employee engagement, training, retention. Another classic example, I say it is very good example of a successful low cost airlines, which is Ryanair. Ryanair become Europe's largest budget carrier by aggressively cutting costs, charging separately for extras like baggage and seat selection, and using secondary airports to reduce fees. Its ultra low fare strategy made flying accessible to millions of passengers at Europe. This holistic approach ensured that the leadership team didn't chase holistic approach ensured that the leadership team didn't chase profits at the cost of safety, service, or employee morale. It's a clear example of how corporate governance and strategy execution can align to create sustainable performance in the airlines industry. Of course, the sector faces challenges, volatility in fuel prices, currency fluctuation, and intense fare war affect profitability. Regulatory requirements like DGCA norms, airport slot allocation, and taxation add further complexity. The industry is highly competitive with thin margins, making it difficult for airlines to balance cost, efficiency, and customer service excellence. But opportunities are equally strong in this area. India's government is pushing regional connectivity through schemes like UDAN, opening Tier 2 and Tier 3 city routes, global alliances, and code sharing agreements offer Indian carriers access to international markets. Moreover, technologies like predictive maintenance, AI driven scheduling, and data analytics for routes optimization are transforming how airlines operate and compete. Today, we bring interesting case studies from Case Study Digest Volume 1. Through these case studies, you will be able to appreciate how strategic, financial, regulatory, and tax consideration converge in real business decisions, which is the very sense of integrated business solutions paper. We are privileged to welcome CA Sujana Balaji, a highly respected chartered accountant, to today's session. Despite the peak of the audit period, she has graciously accepted our invitation to share her expertise. Her insights will enable you to connect academic learning with practical applications in business and governance. With this, let us commence today's discussion and explore the case in detail. Ma'am, over to you.
Thank you, sir. Thank you. Very warm welcome. Can I just share my screen?
Yes, ma'am.
Yes, sir. Is it visible right now?
Yes, ma'am.
Okay. So there will be two case studies. Can I take it forward?
Yes, ma'am.
Yes, sir. Okay, perfect. A very good evening to everybody. Thank you so much for attending the session. I am Sujana Balaji, and I am a practicing chartered accountant. I will be taking you through two case studies today. So the session will be factored in this way. We will do a case study 21. We'll start with a fairly simple one, and then we will move to the next case study, which is in the civil aviation sector. We will try to wrap it up by 9 o'clock. So with that, I will start the session. So this is case study 21. We will read through it, we will understand, we will also go through the questions, and then we will look at the solutions. So I will also be giving you some time to understand, process the information, think of the solution, and then we will move into the answers. So case study 21 is on Cycles India Limited. This focuses on CVP, which is cost volume profit analysis. So it will also help you to it will take you through activity-based costing, how setup cost will affect affect the profitability. So yes, Cycles India Limited manufactures cycles for both adults and children, and this is the information that they've given to you. on the cycles which are made for children. So you have a monthly demand and production of 20,000. So there are two different segments. First is the traditional CVP analysis, next is the activity-based CVP analysis. So the monthly production is the same in both cases. Again, the selling price and variable cost is same in both cases. What is different here is the fixed cost per month. So under the traditional CVP analysis, you will have a fixed cost of 20 lakh. Whereas in case of activity-based CVP analysis, you have a cost of 16 lakh. Which basically means that there is an additional cost driver which has been identified under this activity-based costing, which is the number of setups, which has been considered, which has not been factored in this traditional CVP analysis. So the number of setups is given as 800 and the cost per setup is given as rupees 500. The additional information that he's given you is the fixed cost of 20 lakh per month under traditional CVP are those that do not vary with volume. So the only factor that is considered here is with respect to the volume, the total fixed cost is 20 lakh. Following an activity-based costing study, the fixed costs that do not vary as per volume or any other cost driver has been identified as 16 lakh per month. So he's saying that's an additional setup activity which has been considered as an activity under the activity-based costing. However, it's not been done so in the traditional method. The study has revealed that a milling machine is used to cut metal into steer support, and production of these steer support takes place in batches of 25 units. So he's also given you that the setup number of units per setup is 25. The total number of setups is 800, and the cost per setup is 500. Once a batch for children's cycle is finished, the next batch would be that for adult cycles. So he's saying they will be intermittently children and then alternated by adult cycles. Therefore, each batch, there would be a setup change. For each batch, there would be a setup change. So which means there would be a setup cost also involved. So if 20,000 children's cycles have to be produced, the number of setups required would be 20,000 steer support divided by 25 per batch, which is 800 setups. So that's why he's arrived at the number of setups as 800. Each setup cost is 500, comprising of materials like change of oil, jigs. So these are regular changes which are linked to a setup, which are not linked to a volume directly, which are linked to an activity called the setup. The cost was previously pooled together with the fixed cost under the traditional CVP analysis. The plant manager would like to keep the number of setups minimum since they reduce the capacity of the machine. So very important that usually the number of setups ideally would be expected to be minimum because it will reduce the cost of the setup. Like you see that each setup cost is 500. It will also give you some downtime on the machine. So ideally everybody would like to reduce the number of setups. Suppose that at any time the milling machine can be used to produce batches of either adult cycle or children's cycle. He proposes to increase the batch size, the children's support, to 100 units in a batch. So from 25, they are doubling it. They're saying it will be 100 units per batch. The number of setups will reduce from 800 to 200, right? So 800 would be 20,000 units, which is the monthly demand of production, by 25 units, which was the units per setup, 25 units, which gave you the number of setups as 800, will now reduce if I've increased it to 100. It's a 4-time increase, right, in the total number of batch size. So that will directly reduce it by 4 times. So from 800 divided by 4. If you can see it another way, 800 divided by 4 would be 200. So you will reduce the number of setups to 200. Due to a larger batch production, the additional inventory storage area would be required to store. That will cost the company rupees 1 lakh per month extra. It's very, very, very important that if the number of batches the units per batch increases, the number of setups reduce, there will be additional inventory and you will be required to store this inventory at a cost of 1 lakh per month. So it's a very, very important point here, which we will be factoring it in our answer. So just keep this in mind. The annual manufacturing capacity is 10 lakh cycles. The demand for cycle has been increasing within India. Management wants to increase the annual capacity to 18 lakh cycles. Due to increased production requirements, the CIL has bought additional machinery for the production line. All assets were purchased by account pay check, and below is the detail of plant and machinery. So they're giving you that the opening WDV was 10 crore. After reducing depreciation, the WDV is 10 crore. The new plant and machinery purchased and put to use on 30/6/2023 is 5 crore. And there's new plant and machinery purchased and put to use on 31st December 2023, which is another 5 crore. So opening you have 10 crore, and then you have addition of 10 crore, which June you have 5 crore, and December you have another 5 crore. Due to increased production requirements, the need for storage space, both for raw materials and finished goods, has increased manifold. Storage costs at CIAL's factory site that manufacture cycles very expensive, hence management wants to consider the option of implementing an effective JIT system. So very, very important. When do you go for a JIT system? A JIT system you go when you have some standard products, some stable production, you have total quality management, you have less errors, you will have less wastage, you will have something that's more predictable, some stuff which are, interchangeable between two different cycles. So that's when you will go in for a JIT system. Versus if there are many complex workflows or there are a lot of, how do I say, a lot of customizations involved. In that case, you will not be going for a JIT model. If there are very, very complex workflows which involve a lot of customizations, you won't go for a JIT model. So under the JIT model, just a second. Okay, so hence the management wants to consider implementing a JIT system for material procurement and production in order to reduce the need for additional storage area. So just in time basically means that, as soon as you get the customer order, when you have the intimation, you will start production. So there are a lot of benefits involved in a JIT system, but there are also a lot of prerequisites for a JIT system. Under JIT, the materials will be delivered directly to the machine on the shop floor. Also, JIT being a pull system initiated by the customer. Once the cycle is manufactured, it will be sent out to delivery to the customer immediately. During the meeting, as the management accountant, you have pointed out that the JIT system needs to be sufficiently supported by an effective backflushing system that will account for the components of materials used in the production process. Given the large production volumes and the fast turnaround times under JIT, backflushing system is the ideal solution to account for the components. So you will have backflushing as a concept, and then you will also have another traditional system. So what essentially happens is in the backflushing system, you will have some standard. So example, I'm making a pizza. I know that I need say 300 grams of dough. I need so many toppings, so much of cheese. So as soon as I prepare one pizza, the system will automatically factor that 300 grams has been used, 300 grams of flour, 100 grams of cheese, 100 grams of vegetables have already been consumed. It's something that the system will backflush it. So based on production, it will automatically backflush. But for an effective backflushing system, you will need again stable, standardized production frameworks. You should have less errors, less wastage, less variances. You should not have complex workflows. You should not have a system where there are a lot of variances. You should again not have a system where there are a lot of customizations involved. So it's very, very important to have a good backflushing system. So you have pointed that out as a management accountant. So CIL has recently decided to start selling cycles to professional cycles in India. International exposure and increased availability of facilities has improved career prospects for professional cyclists. Yet, at present, the market segment is at a nascent stage. The company is also foraying into this segment for the first time. CIL has opened a small dealership shop in Mumbai specifically to sell these high-value professional cycles. So, on March 31st, 2024, it imported its first batch of 100 professional cycles to a company in France. The details of expenses incurred at the dealership in Mumbai are given below. So they have given you that the cost of purchases, which is based on the supplies invoice, is 50 lakhs. The handling cost linked to imports is 6 lakh. The salaries of accounting staff at the dealership is 5 lakh. The sales commission paid to sale agents is 8 lakhs. After sales warranty cost is 4 lakhs. Import duty is 2,50,000. Freight expenses 2,50,000. Insurance of purchases 1 lakh. Brokerage and commission paid to indexing agent is again 1 lakh. So these 100 professional cycles are held in stock as at March 31st, 2024. So none of these have been sold. These are all in stock, which is at the end of the financial year. The current market price for these, so we'll assume that the financial year is 2023 to 24. For the purpose of this problem, financial year 23-24, starting April 1st, 2023 to March 31st, 2024. The current market price for these professional cycles is 64,000 rupees per unit. CIL also has a firm sales contract. So I have a firm sales contract with a small cycle dealership for 30 cycles at 65,000 per unit, which cannot be settled yet. I have not settled it yet, but I have a firm contract. The incremental selling cost is 2,000 rupees per cycle for all its cycles. 2,000 unit per unit for all its cycles. The manager of the dealership for imported cycles is of the opinion that selling it at 64,000 per imported professional cycle, they will not be able to earn any profit margin. The same is true even for the firm order of 30 cycles, which the sale price is 65,000 per cycle. So she wants to increase the selling price to 85,000 per cycle. Her annual performance is based on the profit that this dealership venture generates. Hence, she is very insistent on increasing selling price of the imported cycles. So with this background, I will give you probably 2 minutes and we will quickly go to the question. So we'll quickly jump into the question. The first question is, given the information about sales, plant and machinery, the total amount of depreciation that can be claimed as per income tax 1961 for assessment year 24-25. The company does not opt for 115 BAA, 115 BAB. So there are 4 options in front of you. Again, I'll give you 2 minutes just to compute it yourself and then we will go to the answer. Yep. So let's quickly look at section 32. So you know that for plant and machinery, the depreciation rate is 15%. But there's this concept of additional depreciation, right? So just a second.
Yes, ma'am. The additional depreciation allowed for the manufacturing company.
Yes.
And for the ship and leather company, so all the manufacturing company it is allowed, ma'am. It's a additional depreciation 20%.
Perfect. Yes, absolutely right. So I'm just pulling up the relevant section. So they're saying here that in case of any new machinery or plant which has been acquired or installed after 31st March 2025, an additional depreciation of 20% shall be allowed as deduction under clause 2. So which is great, which is what it says. But then it's very, very, very important to note that if a company is opted for the new lower rate of income tax of 22% under 115 BAA, you can see that, just a second, I'll just quickly scroll down and show it to you. And additional depreciation is not available. Yes.
Not allowed, ma'am. The lower depreciation, 22%, 18% is not allowed.
Perfect.
Only the default regime, if you opt for, then definitely it is allowed.
Absolutely, you're right. Yes. So he specially mentioned that clause 2A subclause 1 of section 32 is not allowed as a reduction. Therefore, you will not be allowed this additional depreciation. That's why it's very important that in the question, they have given that the company has not opted for 115 BA or 115 BAB. So yes.
Yeah, if it is put to use less than 180 days, then 50% of that, which means that 7.5%. If it is greater than 180 days, then the full percentage we can use in addition to the normal depreciation of the 15%.
Absolutely, yes, absolutely. So you have 10 crores, and then you have a depreciation of 15%. So the opening, you don't have any additional depreciation. You have one, so that the total depreciation is 1.5 crores. So the new plant and machinery, the income tax access is if it's put to use for more than 181 days, then you will have full depreciation. If it's put to use for less than 180 days, then you will only have 50% of the depreciation. So on 5 crores, which is put to use in June 2023, you will have 15% depreciation. and 20% additional depreciation, which brings a total depreciation of 1.75 crores. For the machinery which is put to use on or after, which is on or after 1st October, 2nd October 2023, which is in December 2023, you will have 15% divided by 2, exactly like you said, 7.5%, and then you will have 10% as additional depreciation, which brings the total to 87.5 lakhs. So together 1.5 plus 1.75 plus 87.5 lakh gives you 4.12 crores. So the correct answer would be B, 4.12 crores. Right? If you have any questions, you can ask me. Otherwise, I'll proceed to the next question. Okay. The next question is, determine in which of the following cases should labor cost not be factored into the cost of setup? In which cases should the labor cost not be factored in the cost of setup? Is it the cost of using temporary labor hired for the particular setup? Is it the cost of outsourcing setup activities? Is the cost of using permanent labor who are idle otherwise? And then is it if additional labor supplies are unavailable in the short term and where no further overtime is possible, cost of using permanent labor who are engaged in the production process? I'll give you a minute to think through and then we'll go to the answer. Okay. So the cost of using temporary labor hired for that particular setup will have to be costed into the cost of setup because they are being hired only for this purpose. The cost of outsourcing setup activities again will have to be factored because you will be incurring cost. Even if it's outsourced, you will be paying some money. So that will have to be factored. The cost of using permanent labor who are otherwise idle. So so when you look at permanent labor cost who are free, who are otherwise idle when you're deploying them for the setup cost. This is basically a sunk cost, right? So you will not be factoring this because it's already a sunk cost. You will need not factor it into the cost of setup.
Yeah, anyway, whether we are running the business or setting this permanent labor, we need to incur the cost.
Absolutely. So regardless, is it indifferent to this particular activity? Therefore, this cost need not be factored into the cost of the setup. However, if you look at additional labor supplies who are unavailable in the short term, where no further overtime is possible, the cost of using permanent labor who are engaged in the production process. This would mean that you're drawing out people who are otherwise doing something else and using them in this production process. So you will have to look at the opportunity cost of, what is it that you're losing to engage them in the activity and this activity process. For example, the contribution, if they are involved in some other activity, say manufacture of not cycles, but something else, then what is the contribution lost? So that will have to be factored into this when you're doing this analysis. So the answer is C, the cost of using permanent labor who are otherwise idle, that need not be factored into the cost of setup. Next would be, which of the following, which is not a prerequisite for an effective JIT system? Which of the following is not a prerequisite for an effective just-in-time system? Is it varying demand patterns? Is it lesser setup time? Is it total quality management? Or is it multi-skill labor force? What is this? What is it? I'll give you again a minute to process it and then we'll get to the answer. So let's look at it this way. In a JIT system, you will definitely need multi-skilled labor force because you could be getting, because you're working on a just-in-time system, you cannot have people who are dedicated to one particular segment alone. So you will definitely a prerequisite would be multi-skilled labor force. You will need people who are deployable in multiple different activities. So labor force should be fungible. So it's a definitely a prerequisite. Total quality management, again, very, very important because you cannot afford errors. You cannot afford variances. You will need to have a very good end-to-end production system. So total quality management, again, becomes a very important prerequisite in a GIT system. Lesser setup time, again, is a very, very important aspect because the lesser the setup time, the more you can produce. Just in time, your time becomes very, very important, very critical resource. So a lesser setup time is definitely important. But what is rather difficult to just accommodate in a effective GIT system is varying demand patterns because you do not have inventory. You will place orders for inventory only when you get the orders. So you cannot have various different demand patterns. You will also have only a limited set of labor force. You will also only have a certain amount of production capacity. You cannot afford a higher lead time in a JIT system. So varying demand patterns are rather difficult to accommodate in a JIT system. Therefore, this would not be a prerequisite. In fact, would be detrimental to an effective GIT system. The others would be prerequisites. That is the answer to the third question. Okay. The fourth question: what would which of the following is not a problem of using backflushing in GIT system? Is it that the production reporting has to be accurate? Is it that the scrap reporting has to be accurate? Is it that unless the software allows picking and backflushing systems to coexist, lot tracing would not be possible? Or is it that backflushing requires no data entry of any kind until the finished product is completed? Which of this is not a problem of using backflushing system in JIT? You understand what backflushing system is, right? I explained it to you. So with that, you can probably attempt this question, please. I can give you a minute. So the production reporting has to be accurate. This is definitely very, very important that the production reporting has to be accurate. If the production reporting is not accurate, then the cost that you backflush would be wrong. If your production reporting is wrong, the costing would again go for a toss. So this is definitely not an advantage of the. I mean, it's very, very important. This is a concern. If the production reporting is not accurate, the backflushing costing would be wrong. So this is again a small problem. I wouldn't call it a problem, but this becomes a very important aspect of a backflushing system in JIT. The scrap reporting again has to be accurate. The scrap reporting is not accurate. Again, the items costing would go for a toss. The COGS would be affected. So the scrap reporting again becomes very, very relevant. And unless the software allows picking and backflushing systems to coexist, lot tracing is not possible. This is again a very, very important aspect because if this is not there, then you cannot identify what cost has again gone for which. If there is a variation in a particular lot, you will not be able to identify which lot the particular issue went into. So this is again a very, very important that lot tracing is again very, very important, especially when there are certain variances that you will have to accommodate. So the last aspect, backflushing requires no data entry of any kind when the finished product is completed, is actually a benefit of the GIT system. It is beneficial that every time that a production process it moves forward. No, you don't have to keep saying I've used so much of X material, I have used so much of Y material, I have used so much of particular type of labor. So you don't have to keep feeding this information until the finished product is produced. So that is definitely an advantage of this backflushing in GIT system. So this is not a problem. In fact, it is a advantage. It's a benefit of using a backflushing system in GIT. So D would be the answer. Can we go to the next question? Which of the following factors would make the customer more sensitive towards price of a professional imported cycle? Is it a higher perceived quality of the cycle? Is it a practical difficulty in comparison of imported professional cycle with any other alternative available domestically due to lack of awareness? Is it that imported professional cycles being unique can give users recognition among peers? Or is it that high proportion of expenditure, which is the high proportion of product cost to the customer income, would make them sensitive to the price of this professional import cycle? So this is a fairly easy question, so I'll probably give you 30 seconds. You can go through it and discuss the answer.
Ma'am, we are answering through chat box.
Oh, you okay? I am not seeing the chat box. I'm so sorry. Let me quickly. Wait. I think I'll have to. There's a separate portal, right, for the chat box. There's a separate portal, right? Can somebody from the technical support team help me with this, please?
Ma'am, here itself in the Zoom itself, you can able to.
I can do that. Okay, great. Oh, perfect. Perfect. Great. Perfect. Thank you. 5D. Perfect. Yes, that's the right answer. You will have a higher proportion of correct. So in case of A, B, and C, they will actually be more. I mean, they will prefer spending more money if it means that the perceived quality is higher. If there's practical difficulty in comparison, it won't affect them. It won't make them sensitive to the cost of the professional cycle. Imported cycle being unique and give user recognition. This will not make them sensitive to the price. The one thing that will definitely make them sensitive to the price would be the higher proportion of the product cost to their income. So if it's if it's 20%, 30% of their income, that will definitely make them sensitive to this cycle cost. It was a fairly simple question. Now we'll go to the descriptive questions. Find the break-even point per month and the profit per month under the traditional CVP method and the activity-based CVP method, where the batch size is 25 per batch. So you have all the information. You already have the case study material with you. So I will probably give you 5 minutes. Would that be fair? Or maybe 3 minutes? We can solve the answer together also. Seven 11, we will go to the answer. Anybody has worked it out, you can share the answers in the chat box. 7-11 now, we will go to the answer. So they've given you that the selling price per unit is 16,000. The variable price is 15,000. So you know that the contribution is 1,000 rupees, which is 16,000 minus 15,000. The contribution per unit is 1,000 rupees. They've also given you that under the traditional cost method, the fixed cost would be 20 lakh, right? So where the fixed cost is 20 lakh, the break-even point would be the fixed cost divided by contribution. So in this case, it's 20 lakh divided by 1,000, which is 2,000 rupees, 2,000 units. So in this case, the break-even point will come at 2,000 units. The monthly demand, the monthly production is given as 20,000 units. Therefore, the profit. So there are 2-3 methods to do this. I mean, there are 2 methods to do this. Okay, I'd like to do it in the second method, but the institute material has given one, so I'll take you through both. So in case 20,000 units, each giving you a contribution of 1,000 rupees, so which will give you 2 crores minus fixed cost of 20 lakh will give you 1.8 crores. So 20,000 into 1,000, 2 crore minus fixed cost of 20 lakh is giving you 1.8 crores. So 1.8 crores is profit under method 1. What I would otherwise like to do is very straightforward. See, you know that the break-even point is 2,000, after which everything that you make for the contribution is going to be the direct profit. So what I'd like to do is 20,000 minus 2,000. So 18,000 units into 1,000 would directly give you the break-even point of 1.8 crores. Then the profit of 1.8 crores. So it's nothing but 20,000 minus 2,000 into the contribution margin is directly going to be your profit. Because after you've broken even, everything that you make is profit, right? The contribution and every additional unit is going to be a profit. So which is 1.8 crores. So this is under the traditional method. We'll go to the question right now. So there are 3 aspects, okay? So analyze the impact of break-even points and the profit per month and the batch size. So okay, also I don't think that we went through the second part under the activity-based costing, because we just went through the traditional method. So under the activity-based method, everything remains the same. The selling price, the variable price, the contribution remains the same. But the fixed cost under activity-based method is 16 lakh. Whereas here it is 20 lakh. In this case, it is 16 lakh. But you will also have a fixed cost for the purpose of setup. So if you look at the setup, you will have the setup cost for 25 units per setup. The total demand is 20,000. The batch size is 25. The number of setups is 800. So 20,000 divided by 25, you have 800 setups. And the question has mentioned that the cost per setup is 500, right? So just a second. Part. Each setup cost is 500. So it's giving you that the cost of each setup is 500. The cost per setup is 500 rupees, which means the total cost that you incur for 20,000 units is 4 lakh. So in case of this activity-based costing also, 16 lakh would be the fixed cost, which is not linked to any cost driver. The fixed cost which is linked to this cost driver would be 4 lakh. So the break-even point would be 16 lakh plus 4 lakh, which is 20 lakh divided by 1,000 units, which is again 2,000. The fixed, incidentally, I mean, because the total production is the same, you have BEP being same in both activity-based and traditional method. So the BEP number of units is 2,000 in both these cases. You see, break-even point under the traditional method and the activity-based method is same in this case. But a very, very important factor that you come to know is that the number of setups that they're doing is 800 setups. They're incurring a cost of 4 lakh per setup. Here it is, the BEP is the same because he's given you the same information for the same set of 20,000 units. If he had given you if he had given you on a per unit basis for the different production quantities, of course, this would be different. But because it's given for the same number of units, incidentally, the BEP is the same. BEP number of units is the same. So again, very simple, that the total monthly production is to 20,000. So Method 1, you will have 16 plus 4 lakh, 20 lakh as the fixed cost. So you have 20,000 units, giving you a contribution of 1,000, which is 2 crores, minus 20 lakh, which is 1.8 crores. Otherwise, again, you have 20,000 minus 2,000 into 1,000, which is 1.8 crores, which is very similar to what we did above. But a very, very important factor that you will have to note is the more number of setups, the more time is consumed, the more effort is consumed, the more cost it incurs, the more number of oils and jigs, a lot of changes. So if you have a lower setup time, you can increase your production time, you can increase the number of items that you produce in a limited number of time. So it's very, very important that you keep the setup time very, very low, and the setup cost also very low. So now let's look at the second part of this question. They are saying, analyze the impact of BEP units per month and the profit per month when the batch size of manufacturing children's support increases from 25 units to 100 units per batch. Okay, so they are saying that the number of units per batch is increasing from 2,500. I will give you 2 minutes to work this out. So this is 7:15 right now. 7:18 will reconvene. You can, if you have already worked out the answer, you can give it to me in the chat box. And probably quickly go through the answer. So in this case, the selling price is the same, the weighted price is the same, the contribution again remains the same. But what is changing is, I told you when we were going through the question that this was one very important factor that you will have to look at when they change the number of batch size. Due to a larger batch size of production, additional inventory storage area that would be required to store will cost the company 1 lakh per month extra. So very, very important point that I told you when we were reading the sum together. So when you increase the number of batches, you will have a higher production cost, higher inventory storage cost of 1 lakh per month, which is extra. So what you will have to do here is, under the activity-based costing, you will have 16 lakh. The total cost would be 16 lakh. The setup cost would be for 20,000 units, you will have a batch size of 100. The number of setups would be 200, right? For every setup will cost you 500 rupees. The total cost of setup would now be 1 lakh rupees, which is the cost that we factored here. For so see how it decreases significantly from the 4 lakh. You were earlier spending 4 lakh for setups. Now, by increasing the number of batch size, you have reduced it by 3 lakh. So the cost of setup is now decreased from 4 lakh to 1 lakh. So 3 lakh saving, you directly get there. But of course, there's some additional storage cost for inventory, which is 1 lakh, which is increased, because of which your break-even point, if you see, number of units has reduced from 2,000 to 1,800. So if you see, the fixed cost totally that I'm incurring is 18 lakh. So the BEP has decreased from 2,000 units. So otherwise, earlier you had to make 2,000 units to break even, but now it is enough if you make 1,800, which means your profitability is also going to increase, because your break-even point, every company will try to aspire to reduce their fixed cost, to reduce their break-even point, because every incremental product that they make will result in additional profits. So from earlier 2,000 units, now it's been reduced to 1,800 units, which is nothing but your 18 lakh divided by 1,000 rupees, which is your contribution. So there's 1800 units. The monthly demand is 20,000. So profit under method 1 is nothing but 20,000 into 1,002 crores minus 18 lakh, which is 1.82 crores. This is nothing but the saving in cost. So here you are spending for 4 lakh. Now you are saving 3 lakh, but you're also incurring an additional cost of 1 lakh. So together you're saving 2 lakh. So this 2 lakh is the only profit that's been translated here. So from 1.8 crores, you've increased your profit by 2 lakhs directly because of this. Of course, with the higher number of production, your savings will be much higher. But yes, essentially what you've done is you have increased your profits by 2 lakh because of increasing the number of batches per size. Right? Okay. So the next question would be, if you have any question, please let me know in the chat box. Otherwise, we can proceed. So the next question is, explain how the number of setups and the cost of each setup will impact the flexibility of the milling machine. Yes. You have any question? Saminathan, you have any question? Oh, no, perfect. Okay, great. So we'll proceed to the next one. Thank you, Saminathan. And explain how the number of setups and the cost of each setup will impact the flexibility of the milling machine. So this is something that we've already discussed. So I'll take you to the answer directly. So setups will reduce the production utility of the machine, because the more number of setups will reduce the production utility of the machine, because the more number of time is being spent on the setup itself rather than the production. So utility will definitely come down. A lower number of setups or lower setup time can definitely improve the utilization of the machine, because the machine can be deployed in doing the actual core production activity. So it also gives the company flexibility to change the batches, changing the batches produced in the milling machine. So they can do a children's cycle, they can do adult cycle as per the requirement. The other factor that will impact the flexibility of the production would be the setup costs. So very, very important that, the lower the number of setups, the lower setup cost will incur, right? Lower setup cost we saw in our case from 4 lakh, the profitability actually increased by 2 lakh to the same number of units. So the lower the setup cost, the higher flexibility to change batches produced in the milling machine to catch to each type of cycle. And you will also have definitely a cost saving. So that is how it will impact. That's how setup and setup costs will impact the actual milling production. Okay, now we will go to probably the last question in this segment. So we will read all the questions in this 1, 2, and 3, and then we will evaluate it. So evaluate which of these costs pertaining to the 100 imported cycles are allowed to be included in the cost of inventory in the books of CIL. So they're giving you a lot of costs, including some admin costs, some import costs, freight costs. So you will have to evaluate under AS2, which would be the cost in AS2, which would be the cost which can be included in the cost of the inventory in the books. The next question is, calculate the net realizable value of the inventory of CIL relating to these 100 imported cycles. What is the net realizable value according to you? And calculate the value of inventory of the 100 imported cycles as of 31st March 2024. So before this, I just want to give you a quick background. Let's quickly open Ind AS 2 and see what are the aspects of cost that can be inventorized. And then you can probably take 2 minutes to 3 minutes to solve the question. Then we can go together. This is Ind AS 2 that I downloaded from the ICAI website. Okay. So here they are saying the cost of inventory shall comprise of all costs of purchase, cost of conversion, and other costs incurred in bringing the inventory to the present location and condition. The cost of purchase of inventory comprises the purchase price, import duties, and other taxes other than those subsequently recoverable by the entity from the taxing authority. Here what they are saying is, if there is an ITC, should not be costing it in inventory, because this is recoverable from the taxing authority. GST ITC is essentially recoverable from the tax authority. So when you pay your output, you can adjust this, right? So this should not be considered. And transport, handling, and other costs directly attributable to the acquisition of finished goods, materials, and services. Trade discounts, rebates, and other similar items are deducted in determining the cost of purchase. So any trade discount that you get should be deducted in the cost of purchase. Okay. Cost of conversion was not there in this particular case because it's a traded item. They are purchasing the cycles directly. So I will not be spending time on this. Other costs. So other costs that are included in the cost of inventory only to the extent that they're incurred in bringing inventory to the present location and condition. For example, it may be appropriate to include non-production overheads, so the cost of designing products for specific customers in case of inventories, the cost of inventories. Examples of cost excluded from the cost of inventories and recognized as an expense. So they're recognized as an expense, they are not inventorized. Would be abnormal amounts of wasted material, not normal loss, abnormal loss. Storage costs, unless these costs are necessary in producing or in the production process before further production stage. So we are saying storage costs unless these costs are necessary in the production process before proceeding to the further production stage, not when the inventory is ready for sale. Administrative overhead that do not contribute to bringing the inventory to the present location and condition, and selling costs. So these are the costs which are not to be included. So with this background, I'm going to give you 2 minutes to quickly calculate the cost of inventory, and then we will go to the answer. So time is 7:26, 7:28, we will go to the answer. If you have any questions, you can feel free to text me in the chat box. So 3 lakhs, great. Okay. You all have another minute, I guess. Oh, yeah, it's time. Perfect. Thank you, Swaminathan. That is perfect. So I will quickly go to the solution. Okay. Okay. So as per Ind AS 2, the following cost can be included: the cost of purchase, the cost of imports, cost of import duties, freight expenses, insurance, brokerage. These can be included. But what cannot be included is salary of accounts department staff, because it has nothing to do with the cost of inventory. Bringing it to the production location, there's no relevance, right? And then sales cost cannot be included. So sales commission, after sales warranty cost cannot be included in the cost of inventory. So as per AS2, you can only consider a cost of 63 lakh, which is perfect, which is what Mr. Swaminathan pointed out. Thank you, Swaminathan. So 63 lakh would be the cost of inventory that you can inventorize, right? The next question would be calculation of NRV related into the 100 import cycles. So what you have to be very careful here is you have to segregate this, because we know that the company has a firm order for 30 cycles. Company has a firm order for 30 cycles. For the other 70, they do not have a firm order. They only have an estimated selling price. So another important aspect that you have to look at in Ind AS 2, let me quickly show you that. I'm sure you're all aware of it, but let me again quickly. When I when I study for the exam, I always look at the bare standard, the bare act. I don't know, it stays with me longer than if I don't see it, even though I know it. I'm trying to do the same thing when I'm taking the session here. So net realizable value is the estimated selling price in the ordinary course of the business, less the estimated cost of completion, the estimated cost necessary to make the sale. So this is what net realizable value is defined in Ind AS 2. So yes. Thank you. So the net realizable value is the estimated selling price less the cost of the cost necessary to make the sale. In this particular case, they had given you in the case study that, they are going to incur a cost of 2,000 rupees per, just let me quickly go to that. So they are saying here that the current market, so 100 professional cycles which are held in stock. The current market price is 64,000. We have a firm sales contract for 65,000, which cannot be settled yet, and the incremental selling cost is 2,000 per cycle. For the 30 cycles, the net realizable value will be 65,000 minus 2,000, which is 63,000. And in case of the other 70, the net realizable value will be 64,000 minus 2,000, which is 62,000. Very, very important here, but the net realizable value, incidentally, could be, say, example, this is 68,000. Minus 2,000, you have 66,000. You will have to do the lower of cost at NRP. So you cannot increase the costs. Very, very important here. You should not look at it holistically. You will have to look at it per inventory item also when you're going to segregate it this way. So in case of 30 cycles, the net realizable value is going to be 65,000 minus 2,000, which is 63,000. And for the other 70, it's going to be 64,000 minus 2,000, which is 62,000. Let me quickly go to that part here. So the net realizable value for the remaining 70 cycles, 62,000. For the firm contract, it is 63,000 per cycle. Very, very straightforward, but yes. And the cost of inventory. So they're also asking you to calculate what will be the total cost of inventory. It's very important that, because your cost is 62,000 and your 63,000 and your net realizable value for 70 cycles is 62,000, you will have to write down your stock to the extent of 70 cycles by rupees 1,000. So 70 cycles into 1,000 rupees per cycle, you have to write down your inventory. So 70,000 inventory write down is required. So even though your total cost is 63 lakhs, your book value, your carrying value of inventory in books should only be 63.3 lakhs at the end of 31st March 2000. The value of 30 cycles would be 30 cycles into 63,000, which is 18,900. The value of the remaining cycles, 70 cycles at 62,000 per cycle would be 4340. Total inventory value will be 6230. So the cost will be 63,000. The net realizable value is 6230. The difference is nothing but 1,000 rupees per 70 cycles. 70,000 rupees would be the difference. Again, because they've asked you to present the value of cycles, that's why they've given you the number here. But otherwise, simpler logic would be 63 minus 62.3 would be 70,000. That's something that you cross verify. Sorry, 60. Sorry, what was the question? 62.3. 62 or 63? I didn't understand that question. 62 or 63.62? I don't understand.
Ma'am, then that is the answer for the earlier question, ma'am. That is 62,000.
Okay, got it. Perfect. Got it. Perfect. Thank you. I was a little late to read this. Thank you so much. Perfect. Okay, so that brings us to the end of the first case study that we had today. I was told to give you a small break and then we can reconvene for the civil aviation program, the solution. So, is there anybody from technical support? Can I give them a 10-minute breakout?
Yes, ma'am. Generally, they will give 10 minutes break, ma'am, 10 to 12 minutes.
Okay, probably you can take 12 minutes, no worries. It's 7:33 right now. We will reconvene at 7:45. It's 7:33 right now. We'll reconvene at 7:45. Thank you so much, guys. Thank you. case study. Let me quickly share my screen. It's a very long one, so we will try to quickly read it. Okay, so this is case study 13. This is case study 13, which I think Mr. Deepak very beautifully explained today. So this is going to be talking about the aviation industry, how it has changed, how connectivity has become important, regional connectivity schemes. The case study is also going to take you through, how on-time performance is important, how low-cost carriers have come through, what they're doing to remain low-cost carriers. So this will give you a very good perspective, and then this will also be eventually moving into a balanced scorecard. So balanced scorecard, like will have 4 different perspectives, including a financial perspective, a customer perspective, an internal business process perspective, and also a learning and growth perspective. It's very important that in today's world, it's not just limited to quantitative factors. A lot of very important qualitative factors. A lot of, especially the hospitality industry has embraced this significantly. Also the aviation industry, because, pegs on this hospitality. It's also, partly hospitality. So a lot of these hotels in the current landscape have been using a lot of metrics, including customer satisfaction scores for their performance evaluation, and how they innovate and grow. How, for example, in terms of airlines, how on-time performance has become a very important factor. Apart from the financial perspective, there are other very important aspects that are going to be involved. This framework is a strategic framework which has been, I think, developed in as early as 1992 in a HPS review by some business scholars Robert Kaplan and David Norton. And it's it's basically a broadened performance measurement. Balanced scorecard is basically a broadened performance measurement. It will give you a complete picture of not just the financial perspective, like I said, but other alternative perspective also. A lot of leading Fortune 500 companies like Apple, Volkswagen have also embraced this. This will also help leaders implement their long-term strategy. So with this very brief background in mind, let's quickly go through case study. So civil aviation industry and company outlook. Aviation, because you have this case study, I'm going to just go through it and not explain it much. We will look at it in the answer segment. So the civil aviation industry and company outlook. Aviation industry has the power to change economic landscape of the country. Connectivity is important for generation of economic growth, trade, and tourism. Millions depend on this industry for their employment, either directly or indirectly. So a significant amount of India's GDP comes from the sector. Tourism sector. The recent past, the entire industry worldwide was crippled with the COVID pandemic. The years 2020 and 21 proved to be the most trying and difficult period for all companies within the industry. Especially tourism suffered a lot because of these lockdowns and limitations on travel, especially international travel. So when everything seems to be going against you, remember the airplanes take off against the wind, not with it. This was said by Mr. Krishna Gupta, who was the managing director of KG Airlines, one of India's leading airlines. The quote hangs on the wall of the entrance of KG headquarters in Gurugram. It has taken a few years to rebound to the normal scale of business operations. With the impact of COVID-19 subsiding and easing of travel restrictions, there had been a rebound of passenger traffic. Like we all know that 2023-24 saw a significant boom in this tourism sector because everybody wanted to travel, see more places. There was a significant increase in travel. Indian economy being considered one of the fastest growing economies with projections of GDP growth of 7% year on year. Private consumption, growing economic activity in both manufacturing and service sector has spurred since 2022. So these are just general stories, right? In India, the passenger traffic has increased since 2022 with the rise of disposable income, rapid urbanization and increase in working class population. The growth in the demand for air travel is expected to persist. Tier 2 and Tier 3 cities are also expected to play a pivotal role due to greater spread of economic activity and increasing population in these cities. The government is focused on building and expanding modern infrastructure facilities across the country in order to support the domestic civil aviation industry. Almost 100 new airports will be operational by 2028, giving scope for development of new regional routes that can provide excellent connectivity within India. It is also expected that the domestic aviation requires at least 4,000 fleets within the next 2 decades in order to meet the anticipated demand. So this is a background. This background in mind, let's move to the actual case study. KG Airlines was founded in 1996 by Krishna Gupta of KG Partners and D. Gupta. They're also a significant player in the aviation industry with KG Partners holding 59% stake. while D. Gupta Singapore company DGSX owns 47. In August 1999, KG Airlines placed a firm order for 50 A320-200 aircrafts with plans to commence operations in mid-2000s. The airline received its inaugural aircraft in August 2000, year after its initial order, nearly a year after its initial order. This becomes important subsequently. I'll tell you why. The maiden flight connected New Delhi to Mumbai. By the close of 2022, they had a fleet of 270 aircrafts. Additional 40 were acquired in 2023. And now they approximately serve 49 cities across 25 states, carrying a total of 90 million passengers. They also have a symbol in their NSE. Oh, no, on NSE. Concise over the board is also given in Annexure 2, Annexure A, which we will be going through shortly. The growth trajectory of the industry holds. Okay, so when we're going through the case study itself, I want you to flag out, like we discussed, the balance scorecard will have 4 different perspectives, which is the financial, the customer, the learning, the operational business perspective, and learning and growth perspectives. So I want you, as and when we are reading it, I want you to mentally start noting down where it will go under. So it becomes very important that, sometimes it's better to read the questions before you come to the answer. So I'm going to tell you upfront that while reading itself, you can save a lot of time by seeing what the question is. So you will be able to, in such type of questions, where the case study is almost 20 odd pages long, you will be able to, save your time, or better utilize your time when you read what the question is. Read what the question is before you read the case study. So in this particular case, it's very important. So balance scorecard is what we've been expected to prepare. So start tagging everything that you're reading into these 4 different segments, and then we will go to, of course, we will see the suggested answer. So the growth trajectory holds significant potential. Several board meetings have taken place in the last 3 months to discuss optimal strategies for expanding their business. During these meetings, the MD said the future abound enticing opportunities, catering to both full-service airlines, boasting premium offerings, and employing a product differentiation strategy, and low-cost airlines capitalizing on a cost advantage strategy. So they are saying there'll be 2 different segments. One will be premium, the other will be a low cost. So low cost would be something similar to Indigo or something similar to Southwest Airways, where you have a single fleet, single aircraft, where maintenance becomes simpler. They don't have a lot of other associated frills, they don't have a lot of beverage options, when compared to a full service carrier, where you will have a lot of premium offerings. So after a thorough study, it was decided that KG has better prospects for developing a low-cost airline. The focus will be on the domestic civil aviation sector. So transition, they have a following mission, vision, and purpose: to provide connectivity to the speed of reliability, to make it affordable. Their vision is to be a leader, providing unmatched connectivity. Purpose is be your guest, we will connect you to the world. So our airline aims to build a loyal customer base by providing affordable rates, on-time performance, courteous and hassle-free service. These are the reassurances that they give. Plus, they also envision growth in size and scale. With 100 new airports coming in India, they want to increase their fleet size and increase their routes with substantial investment of a few hundred crores of INR. If you look at the operational challenges in the airline industry, they realize there are multiple roadblocks: increasing in fleet size, development of more routes. All gives one key element: more aircrafts. For all this, for more routes, for providing connectivity, for increasing fleet size, you need more aircrafts. Unfortunately, due to disruption in the supply chain, aircrafts are short in supply. Moreover, the compound effect of rising operational costs exerts significant pressure on the margins, which again poses a significant challenge for KG. So they're saying that, rising operational costs, and to be a low-cost carrier with the rising operational costs becomes a significant challenge to be a low-cost carrier. It will affect the margin of the airline. So this is very important when you look at the financial perspective. Aircraft and spare parts availability. The key aspect is the disruption in the supply chain has given rise to a shortage of engines. So manufacturers have not been able to keep up pace with the demand for these engines. And many market expansion plans and new routes have been delayed due to unavailability of aircrafts. Therefore, a lot of these airlines are also extending their leases to keep up with the operations. Because they're extending the leases, the cost also is going up. So many aircrafts have been grounded due to unavailability of spare parts. There's been a shortfall of capacity to meet customer demands on many routes. Also, due to the lopsided demand, because the demand is very high but the supply is low, the lessors of the aircrafts who supply it on lease have been increasing the lease rental. This has also increased the cost substantially. You have to factor all these into the financial perspective when you're looking at it. Increase in the cost of operations, that fuel price, which has been very volatile, has been an upward trend. Therefore, they regularly monitor the fuel price and impact assess the impact on profitability. However, they have not taken any financial instruments to hedge the exposure. They have not taken any financial instruments to hedge the exposure. Again, becomes very, very important in the financial perspective. Another critical component of KG Airline is the cost of leasing and operating aircraft, which includes lease rental, maintenance, depreciation. These are also on the rise. In addition to these, there's also a demand for pilots as well as flight cabin crew. The flight salaries and expenses are also on the rise. The cumulative impact has exerted immense pressure on the operating margins of KG Airlines. So margins are under pressure. Management has emphasized the necessity to pass on these costs to the customer. However, they are operating in a very, very insanely competitive market. So they will have a limit to how much the tickets can be raised without losing competitiveness. This is very important for KG because it's a low-cost carrier. They also have code-sharing arrangements with partner airlines on specific routes to meet the demand. So if they are not able to provide the aircrafts, they enter into code-sharing agreements with partner airlines. So they can cater to such routes. That is what they've been doing. Maintaining profitability in this market-driven passenger ticket fare environment requires them to focus on cost efficiency. Very, very important. Airline has observed a gradual depletion of its cash reserve due to these factors. So you have these operational highlights. The available seat kilometers in millions is 1,14,000 in 2022 to 7,400. It is now increased to 1,15,000, which is a good indicator. The revenue passenger kilometers has increased from 52,000 to 94,000 million. The passenger load factor, which means how many passengers are accommodated in a flight. So 100% is the total capacity. From 73%, it's increased to 82%, which is again a good indicator that the number of passengers per flight. Say, for example, there are 100 seats in a flight. 73.86 flights are, it's of course, this is an average number, that's why it's in decibel. But essentially means that, 73 seats are occupied, whereas now in 23, 82 seats are occupied, which is a good factor. The cost per available seat kilometer has increased due to all the considerations that I've said above, from 4.65 to 4.85. The revenue, if you see, 3.7 to 4.8, it is increased. But if you see, the cost is 4.85, whereas the revenue is only 4.8. This becomes a very, very important factor. Passenger traffic has increased. The average scheduled flights cancelled, unfortunately, has increased from 0.45% to 1%. The on-time performance, though, has increased from 80% to 88%. The unresolved customer complaints has increased from 4 to 10. So you please keep all this in mind. Wherever there is negative and wherever there's adverse comments, you please bring it into the balance card scorecard framework. Especially on-time performance, especially in terms of unresolved customer complaints. When you're looking at operational parameters, when you're looking at especially the business operational parameters, this will be very, very key. This will be key when you're looking at the financial parameters. So reasons for flight cancellation were primarily due to mechanical faults and software glitches that needed to be fixed due to unavailability of spare parts. There are also technical and commercial reasons due to non-availability of staff, pilots and cabin crew. The staff attrition has increased from 10% to 15%. Very, 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 very important. And you're looking at the staff attrition rate, especially from learning and growth perspectives, the staff attrition rate has increased from 10% to 15%. HR interviews have indicated low pay scales as compared to market rates, combining with long work hours, primarily the reason for employee attrition. Very, very important. Keep this in mind. When flight is cancelled, the airlines has to arrange alternative flights to provide refund to the passengers. In exceptional cases, compensation may be also paid. On-time performance is compiled at 4 metro cities, which is Mumbai, Delhi, Hyderabad, and Bangalore. For delays beyond 2 hours, airlines have to pay a compensation from ranging from 5,000 to 20,000 per domestic flight. So on-time performance becomes very, very important because otherwise it's going to result in a very, very high cost outflow to the airline. Also keep this in mind. So turnaround time is a time between an aircraft landing and a takeoff. The turnaround process is a joint effort for both the ground staff and the flight crew. Besides loading and unloading of passengers, the aircraft will also have to be cleaned, inspected, maintenance work has to be carried out, they have to be refueled. The average turnaround time is approximately 1 hour per aircraft. A faster turnaround time ensures the aircraft is available for the next travel leg journey. It will increase the asset utilization. So Indigo has been consistently trying to reduce this turnaround time. They've been so that they can fly, the number of flying hours can be higher. So that is what every low-cost carrier tries to do. Efficiency in the operation, somebody has said something. Yes, absolutely. They'll go in for release only because there's a huge investment involved. Absolutely right. So this also becomes very important. That's why, Ind AS 116 came through. There were a lot of considerations, especially for airlines. Very, very interesting chapter. I think I covered it in the last session on Ind AS 116. Though not relevant to the aviation sector, we looked at how Ind AS 116 plays a very, very important role in making balance sheets comparable. But yeah, that's deviating. So efficiency will impact revenue generation. Faster turnaround times will increase the revenue generation. But this faster turnaround time is critical not to compromise on the safety. So a lot of, as you know, a lot of safety issues which have to be taken consideration seriously, not just by the company, but also by DGCA, which is a regulatory authority in India. So safety is very, very important for the business operations. And analysis at KG Airlines shows that the delay in turnaround time and safety incidents has indicated that there's a shortage of technical staff to inspect, detect, and report faults in the aircrafts. The existing staff is overworked. So they want to hire 100 engineers who can be trained at their internal training development. The number of passengers has increased from 75 million to 90 million. There have only been few airlines which have managed to capture the majority of the traffic in certain routes like KG Airline has. However, with the expected potential for growth in the future, there may be more airlines who will be willing to operate in these routes. Therefore, it's very important for them to perform efficiently and manage these routes effectively. Again, important. On the routes. The fare structure, they are giving you that the ticket is worth 10,000 rupees, which is sold at a 5% discount per passenger. GST at 5% is collected on the sale. Aviation security fee. So aviation security fee is a fee that is being collected for deployment of, say, CIS of personnel at the airport. So this is a pass-through cost. User development fee is 250 rupees. User development fee again is a pass-through cost which is being paid to the airport operator. So you need to understand that in that aviation ecosystem, you will have an airport operator who will provide the infrastructure, who will provide your, baggage handling systems, who will construct your terminal for you. So all that will be done by the airport operator, for which he will have to be compensated. So they are charging rupees 250 per ticket. And then you will also have to be charged something called aviation security fee for deployment. You've seen a lot of CIS personnel being deployed at the airport, right? So their cost will also have to be recovered. So there's an aviation security fee which is charged. So airlines will collect these security fee from passengers when they book the tickets, and it's passed on to the government. This is used to fund the security arrangements of the airports across the country. User development or passenger service fee is levied again by the airline and passengers book the ticket. And this will be passed on to airport operators like the government-owned ICAI or other private operators. You have GMR, Adani, who are operating airports in the country. So it will be passed on to them. So in return, for collecting these, they are charging a collection service of 5 rupees per passenger. The financial statements are prepared in accordance with Ind AS. The commitment to compliance is evident in the management responsibility statement, which is provided in Action P. So you see that, the strategy is to operate a low-cost, high-efficiency airline. We have a fleet management principle where only a single type of aircraft is used to reduce maintenance and operation costs. Basically, what it means is if I have a couple of different types of aircrafts, so I have a Boeing, one Airbus, the problem would be that I'll have to hire that many number of engineers who can operate on those. And I would have to station them at each of the airports where there's an issue. So instead of this, if I go for one single fleet, then I can train all my engineers only on that particular model. And also, they will only be leasing rather than bought. An economy seat will be the only seat which is offered. Like Ryanair is doing. They will only be offering economy seat because their priority is not luxury. Their priority is low-cost service affordability. The next is on building digital capabilities. This again becomes a very important factor when you look at growth perspectives. So you can see that, to digitalize processes to make them efficient, error-free, cost-effective. They've already have an online booking and check system in place. It also helps passengers utilize these tools to plan their travel, reduce human intervention, help rationalize the cost. Human resources can be freed up from digitization. They can be moved to a more value-adding activity. Commission paid to travel agent can be saved by introducing online booking services, because a huge travel commission is being paid for in the air travel space. So that can also be reduced when they do online booking. A digitization process can also help them to scale up their operations in the future. While these bring significant benefits, scheduled maintenance activities remain crucial for ensuring efficiency and safety of airline operations. So there are also a lot of ancillary services like in-flight entertainment, food and beverages, which will be charged extra, which will not be included in the ticket cost. Very, very important that these are incremental. So they want to generate additional revenue through these in-flight entertainment, F&B services. They also want to partner with the renowned service providers so they can provide good quality food and beverage with a wide range of customer preferences. They can also charge premium rates. When you see that, airlines will charge for a 50 rupee Maggie, they will charge 250 rupees. So they will charge premium rates for these ancillary services. They can improve their revenue. So that is what they are also trying to do. Managing customer loyalty. They are keen on getting recognition for by winning high-profile awards for their services. Again, very, very important that, average ratings from rating agencies also plays a very, very important key role. You will have to see where this goes into your balance scorecard, on-time performance, customer satisfaction, value of money. So these are considered when they are rated into the awards and ratings. The management has realized that the value for money is partly driven by redemption choices of the customer loyalty program. Lots of, Indigo has started offering blue chip. Air India has offered this Maharaja points. So if the passengers are allowed to redeem points towards another flight ticket, it will take away the opportunity to run regular air. So if I earn points and if I use it for air travel itself, the airline will be losing money. So instead, they thought that, this can be offered at a discounted rate. Seat will have to be offered at a discounted rate. So instead, they thought that, I can also offer these loyalty programs by when I'm giving them these reward programs. When the passengers were not completely satisfied with the range of choices, that also becomes a concern. A lot of unredeemed points which the customers have. So to make a quick churn in these redemption or reward points and to increase customer satisfaction, they decided that they will partner with stores in the airport who can accept loyalty points. The passengers can redeem it from the program at these stores and get good value for money. KG also does not compromise on avenues to earn entire ticket fare for the seat. What they're saying is, using their existing customers, they can use them to buy some F&B or some other retail products at the stores in the airport, which means it's additional spend by the customer. This is not coming at the cost of this aircraft itself, aircraft seat itself, because KG can then earn revenue, or the customer will also be happy because they're able to spend their loyalty points. Workforce management, high attrition rate of 15%, we saw from 10 to 15 that it increased. HR interviews indicated that there were long work hours, low pay scale, less opportunity for career growth. So they have planned to tie up with training colleges, technical institutes, where they can be trained the latest developments of aviation. This will allow them to give personal growth and improve staff morale. They'll also give attractive pay packages, rewards, recognition programs, and improve amenities like staff mess, transportation from work, and other employee engagement activities like offsite events, team building activities, recreation rooms, etc. So the performance measurement system has recognized with an increase in size and scale the need to align the resources, which is people, process, and technology, to deliver on these three reassurances which are provided to the customer. This is a very, very highly competitive industry, so they want a comprehensive review of their business. Therefore, they have adopted the balance scorecard method. So giving these challenges, decreased profit margins, and business uncertainties, they want to adopt an operational efficiency and performance as a strategic theme. So they are providing under 4 perspectives, which is the financial, internal business process, customer, and learning and growth perspective. These are the 4 perspectives that are there in the balance scorecard. So this is an extra which will give you, this is just general information. What you will have to know is Mr. KB Chakraborty, independent director, has been appointed as a casual vacancy director on 3rd September 2023. His appointment was subsequently approved by the members in the immediate next general meeting. Very, very important that he was appointed as a casual vacancy director on 3rd September and was subsequently approved in the immediate next general meeting. This is the extract from their management responsibility statement. Now let's go to the questions. Right. So good, we have some time. Good. So let's first look at the multiple choice questions. Aircrafts operated by KG Airlines whether owned or leased, require periodic maintenance. These are high value costs. As of the reporting date, provisions need to be made for the expenses based on a number of variable factors and assumptions, likely utilization of aircraft, expected cost of these high value maintenance on future date, condition of the aircraft engine, etc. So provisions will have to be made based on various factors like utilization, cost of high value maintenance in the future, the condition of the aircraft. There's a lot of complexity and subjectivity of these conditions. The auditors will have to rely on the management judgment in order to quantify the amount of provision to be made. So this would be an example of which type of risk in a statutory audit. Is it an inherent risk? Is it a control risk? Is it a detection risk or a contract risk? I will probably give you 1 minute. 1A, inherent risk. Great. Thank you. Thank you, Saminathan. Thank you. So I will quickly take you through. Again, like I said, go back to the grassroots level, understand. So this is SA 200, right? So risk of material statement, the risk that the financial statements are materially misstated prior to audit consists of two components, which is at the assertion level could be an inherent risk. That is the susceptibility of an assertion about a class of transaction, account balance or disclosure to a misstatement that could be material, either individually or aggregated, before consideration of any related components. What it means is inherent risk is the risk without considering any controls. Without looking at any controls, what is the risk that that particular account balance or disclosure or class of transaction could be materially misstated due to a lot of factors, including complexity or subjectivity or very subjective aspects. So that is inherent risk. Control risk is the risk of material statement could occur in an assertion about a class of transaction, account balance, or disclosure that could be material either individually or aggregated with other misstatements that would not be prevented or detected and corrected on a timely basis by the entity's internal control. This means there are controls in place, but that control will not be able to identify and prevent this material misstatement. So that is a control risk. And then there's an auditor's aspect, detection risk. The risk that the procedures performed by the auditor to reduce audit risk to an acceptably low level will not detect the misstatement that exists and that could be material either individually or aggregated with other misstatements. So detection risk is when I am performing some bit of procedures, but my procedures are not able to detect that particular misstatement. So that is a detection risk. And contract risk could be, in cases where, there could be contracts. This is not defined. This is not there in essays. So this could be a general aspect where, there could be a very, very complicated legal clause that they're given in a legal agreement. And you're not able to understand the legal terms as well as a lawyer or somebody else could because of the complexity involved in the contract formation. So that could be contract risk. Okay, so in this particular case, very, very straightforward that he has said due to complexity and subjectivity clearly fits into the inherent risk factor. Okay, perfect. This is not a control. There are no controls. He's not talking about any controls. He's not talking about any detection. He's not talking about any contracts. Clearly fits into the highest complexity and security. This is inherent to this business. This is a risk which is inherent to this business. So it becomes an inherent risk. Next question. The cashier committed fraud and absconded with the proceeds. The chief accountant was unaware when the fraud occurred. During the audit, the auditor failed to discover the fraud. However, after completion of audit, the chief accountant discovered the fraud. He investigated. He indicated that the auditor did not exercise proper skill and care while performing the audit and performed the audit in a desultory and haphazard manner. So he says that the auditor did not exercise proper skill, perform the work in a desultory and a haphazard manner, is what he's saying. Okay, which of the statements accurately characterize the situation and subsequent action? The auditor exhibited due diligence and careful conduct. Is that the case? Is it that under clause 7 and clause 7 of part 1 of the second schedule of Chartered Accountancy Act and 240 are relevant to the situation? Is it that the auditor failed to plan and perform the audit with attitude of professional skepticism? Or is it that chartered accountant practice will be deemed guilty of professional misconduct based on clause 7 of part 2 of second schedule for the Chartered Accounts Act 1949? So is it 4? Is it 2 and 4? Is it 2 and 3? Is it 1 and 3? I will probably give you 2 minutes or 1 minute. If you have the answer, you can please put it in the chat box. Okay, let me quickly go to the screenshots that I have. So if you see the second schedule, part 1, professional misconduct in relation to a chartered accountant in practice, shall be deemed to be guilty of professional misconduct if he is grossly negligent in the conduct of his professional duties. So that is clause 7. So that becomes very relevant. And also SE 240 becomes very relevant. Because what is SE 240? He said something. I'm sorry. Absolutely correct. True. SE 240 also becomes very relevant because the auditor's responsibility relating to fraud in an audit of financial statements. That becomes very relevant. Here you have to see whether we have to report it to the audit committee, whether I have to report it to the board, what timeline do I have to do this. So SE 240 becomes very key when I'm looking at this particular case. So the answer would be C, both 2 and 3. Right? Okay, we'll go to the next question. So KG Airlines decided to remove the expiration date on the frequent flyer miles. A lot of these airlines will have expiration date saying the loyalty point that you earned this year will have to be used within the next 1 year. So they might have these limitations. A lot of international aircrafts will also have these miles that they credit. So Emirates and all will have these frequent flyer miles, which will have an expiry date, after which you cannot use those points. So they have decided to remove the expiration date. So they have decided to tell you that you can forever hold this. You can redeem it whenever you want. That's what they have said. This has been done to improve customer satisfaction of its flyers using the Kano model. Which of the following attributes does this pertain to? So I don't know if you're familiar with the Kano model. I'll just quickly tell you what these mean, and then you can tell me what the answer is. Threshold attribute would be something which is very basic. For example, if I'm selling mobile phones, it's very basic that I have a calling feature in it, right? So that would be a threshold attribute. A performance attribute would be, performance attribute would be something that depends on the performance of the smartphone. For example, if I have 5,800 mAh capacity of that battery, could be a performance attribute. I say that 24 hours, 48 hours, you don't have to charge your phone. So that would be a performance attribute. A reverse quality attribute would be, for example, I say there's a phone and the phone is a flip model. Some people would like it, some people won't like it. Or the phone has curved edges. Some people would prefer it, some people won't prefer it. They could have the camera opens up. So that could be something that some people like, some people don't like. So that's a reverse quality. It could work, it could not work. The delight attribute would be, for example, you check into a hotel and they decide to give you some sweets. They decide to welcome you with some chocolates or some pastries. So that would be the customer delight factor. So it's something that you would not expect. So in this particular case, you have not expected that they will remove the expiration date in the frequent flyer miles. So that would be a delight attribute. I hope the example was clear. Perfect. That's 3D. Thank you. Thank you, Swaminathan. So we'll go to the next question. Assuming that Mr. Stephen is eligible to be appointed as a director, in line with the requirements, KG Airlines aim to fill up the vacancy caused by the resignation of Mr. K.V. Chakrabarti by nominating Mr. Stephen as an independent director. So Mr. K.V. Chakrabarti, who we discussed, has decided to resign. Okay. So he has resigned and there's a casual vacancy that's come up. And Mr. Stephen is eligible to be appointed as a director, as an independent director. Mr. Ravi Kishan, the board of director, objected saying that Stephen lacks eligibility because he already occupies the position of an independent director in 3 listed entities. So he's saying that is a limit, 3 listed entities is a limit. So evaluate Mr. Ravi's claim regarding Mr. Stephen's suitability with the position of independent director on the board. So is it A, that the contention of Mr. Ravi Krishna is correct regarding Mr. Stephen, that he's ineligible to be appointed being an independent director on already 3 listed entities. So he cannot be appointed in KG Airlines. Is it that no, the contention is incorrect because he is eligible to be appointed in 20 companies, maximum 20 companies. So he can be appointed in KG Airlines. Is it that it is incorrect because Mr. Stephen's appointment, he's eligible to be appointed in maximum 10 public companies, therefore he can be appointed? Or is it that it's incorrect because Stephen's appointment, he's eligible to be appointed as in maximum 7 listed entities, so he can be appointed in KG Airlines? What is correct? Again, you should always go to the LODR and see, so you'll never forget this. Person shall not be a director more than 8 listed entities with effect from April 1st, 2019, and not more than 7 listed entities with effect from 1st April 2020. Right? Provided that he should not serve as an independent director for more than 7 listed entities. Perfect. Yes, it's 4B. This is the extract from 17A of LODR, which says that he can be a director in at least 7, he can be a director in 7 listed entities. So the answer would be D. Right? He can be appointed in maximum 7 listed entities. He's only been appointed in 3 listed entities. So he can be appointed as a director in 7 entities. So yes, his appointment is valid. Right? So given that the few parameters have to be considered while using Porter's 5-force model, match the parameter to the appropriate category of the model. Congestion in airports due to non-availability of parking space, reduced need to travel due to remote working capabilities, low switching cost to choose between airlines, favorable government policies towards investment in the aviation sector. So it's a threat of substitutes, high supplier power, threat of new entrants, and high customer power. I'll probably give you a minute to think through and then we'll go to the answer. Right. Even I thought it could be B. Correct. But it's A, yes. Yeah. I think, yeah, it's A23 now. Okay. So, yes, this this sounded like this could also be right. But the problem is the reduced need to travel to remote capabilities. And if you see low cost of switching between airlines shows that this is more suited, that this shows high customer power because it's a very low cost. He's talking about the cost of switching airlines. So like you said, C to 4 seems to be more relevant than B to 4. That's why A is the answer. I will take you through one by one. The congestion in the airport due to non-availability of parking spaces, so there's a very high supplier power for them to charge whatever cost they want. The reduced need to travel to remote, the reduced need to travel due to remote working capabilities shows that there is a threat of substitute because people may choose not to travel because there is remote travel. So people may choose not to travel. So it's very, that becomes very, very relevant here. So that is a substitute. The substitute itself comes from the fact that people don't want to travel, don't need to travel. So that is why B goes to 1. The low cost of switching the low switching cost to choose between airlines, because a lot of low cost carriers are providing services, which means that there's a very high customer power. And favorable government policies shows that many new entrants can come because there are a lot of subsidies in this particular segment. So any new airline customer could just repeat your model and just come in. So that shows us a very high threat of new entrants. That's why it's A2, B1, C4, and D3. Why it is not B is, it's very, very clear that B has to go to 2. Reduced need for travel due to remote working capabilities shows that there is a substitute for not even requiring travel. The substitute is the absence of travel. The substitute is not going to somebody else. The absence of travel itself becomes a challenge. So that's why it will be a threat of a substitute. Right? Any questions? Let me know. Otherwise, we can go to the question, which is the balance scorecard. This is probably the most important aspect that you'll be seeing today. Okay, so just a second, there's a chat. Perfect, thank you. So construct the balance scorecard for KG Airlines, identifying 2 goals along with the corresponding performance measures for each perspective. Evaluate the relevance of these goals and performance measures of KGI. So we will directly jump into the answer. It's very, very interesting. Yes. So when we look at financial perspectives, the goal one is to lower the cost, improve the cost structure, and increase asset utilization. So every company will only have two goals: to reduce the cost and increase revenue, right? So that definitely will have to, essentially in a balanced scorecard, you can take it that, this could be one of your answers. So lower the cost, improve the structure, and increase asset utilization. So the measures of these costs would be lease cost per month, the maintenance cost per annum, and the cost of available seat with fuel and without fuel. The cost would be another very important measure. So input costs has been increasing. To navigate this, they must vigilantly monitor and proactively secure competitive rates. There should also be utilizing financial instruments to hedge against the exposure. It becomes very important because we read that they are not using anything to hedge these exposure. So they should be looking at instruments to hedge against these exposures. And KG Airline has also planned to lease planes, making it a more viable solution given the airline's low cash reserves. We read that the airline does not have any cash reserve because of its high cost. We read just above. So nevertheless, opting for an outright purchase, although cost effective, involves a significant upfront expenditure or it requires a debt servicing for acquisition. So again, I think that they have done the right thing by going in for a lease model, being the more viable model. And if you see the cost per available kilometer is 4.83, and it's likely to increase until they manage their cost structure. They have to eliminate non-value adding services. They have to standardize seats. They have to, because they're already providing only economy seats. They'll have to explore e-commerce channels, charge customers for extra amenities like in-flight entertainment. They'll also have to standardize planes that it operates to reduce the operational costs like maintenance costs, which you already discussed that, having the same fleet would means that they could have the same set of engineers for maintenance. So their strategy to win market through cost leadership becomes very, very key. So they have to optimize their cost to a lower cost structure. So these would be the aspects that they'll have to consider under the reducing the cost model. That would be their goal. The next goal would be to boost revenue and to broaden the revenue streams. So here you will have the revenue per available kilometer, the percentage of revenue generated from ancillary activities, apart from, maybe in-flight services, maybe food and beverages sales inside the aircraft. So these could be ancillary services and what percentage of revenue, because they could be incremental and also premium. This would increase the revenue yield. And also revenue generated under new routes could also be one factor that should consider. So they want to build a loyal customer base by providing affordable tickets. This will be possible only if the cost can be managed efficiently. Currently, we already saw that the revenue was 4.8 per available kilometer, whereas the cost is 4.85, which means the airline is not making enough money to cover its cost. Therefore, it should pass on some of the increase to the customers without impacting the demand. So maybe it should be planning to increase cost to the customers who are willing to pay for it. So by keeping the base fare low, but by charging more for in-flight entertainment, by charging for the food, they'll be able to get more money from passengers who are able to afford the cost while subsidizing the airline cost for customers for whom affordability is key. So this becomes very, very important. And then they should also monitor and enhance the profitability by maybe route planning should be done to optimize revenue. So a lot of companies, a lot of airlines will have to focus on route planning to ensure that, minimal time is spent or movement. So that also becomes key. They also have to explore opportunities to increase revenue streams. They have to eliminate unprofitable routes. So when they're doing, they should do a review and say this is an unprofitable route. We should exit from this. They should determine new routes which are more profitable. They should have more code sharing agreements with partners. This could also be referred to in the internal perspective. They can also include their ancillary services like F&B, in-flight entertainment. So this will make the overall bundle more appealing. This will also increase the ancillary income. So there will also be something that you should be doing. So this brings us to an end of the financial perspective. Let's go into the customer perspective. So what would the customers need? You will have to retain customers. You will have to acquire new customers, right? You will also have to ensure that, just a second, you will also have to ensure that you are providing maybe on-time performance. You are not constantly canceling flights. So that also becomes a customer pain point. So those two aspects would be very important when you look at the customer perspective. So the number of repeat customers becomes very key. The number of high-profile awards that you won, the latest rankings, because then their customers will be able to see that you are a leading airline. number of new customers that you acquired. So all these would be some parameters through which you will be able to measure whether you are achieving your target of complaint also increase. Absolutely, yes. You should also reduce the number of unresolved complaints. You saw that the customer complaint increased from, I think, 4 to 10. That also becomes a very important aspect. Absolutely, you're right. So they should have a CRM system for maintaining, for managing the number of repeat customers. They should have loyalty programs with different, like we saw that, they had a loyalty program, which again becomes very, very important to retain customers, to have customers come back to the same airline again and again. Because, customers may be indifferent to the number of, as long as it takes them to that destination, they will be indifferent to the airline that they're choosing. But if you try to get them more attractive, definitely I know that there's going to be on-time performance. I know that there's going to be some loyalty points that's going to come through. I know that the aircraft is clean. I know that they're going to provide me some food which I can pay if I want to. So I also know that the fare is going to be low, then the customers will keep repeating, will keep coming back to the same airline. They'll keep picking the same airline. So they'll be motivated to travel again with them, earn points for redemption. So they will also try to churn the redemption points by partnering with airport stores. So I will also be able to know that's a customer. If I get more loyalty points, I'll be able to purchase retail products at the store of my choice. So this will also help them with the brand image for, higher service ratings, above average ratings. They also should provide better connectivity through route plan, which will help them to get a higher market share to acquire new customers. This is on the first aspect on customer acquisition, retention. The next is on the customer satisfaction. Once I've acquired these customers, once I've retained these customers, I should satisfy these customers. So I should have lower number of cancelled flights. I should have on-time performance. I should compensate them for flight delays and cancellations. Unresolved customer complaints, examiners currently pointed out, should be kept low. So that also becomes a very important customer satisfaction point. The average percentage of scheduled flights increased from 0.4% to 1%. So it shows that, the cancellation, average flight cancelled increased. So this affects customer satisfaction. Customers are disappointed when they're not able to travel because they have, the very fact that they book air travel means that they have to be somewhere, very importantly, that they can't otherwise go by road or rail. So it becomes very difficult when flights are cancelled. Despite this, the on-time performance has shown improvement. It has grown. So on-time performance, again, they have to keep the on-time performance very, very high from 72 to 82, I think. I don't remember. But yeah, again, on-time performance is very, very important that they keep this. And they should also compensate them for delays in flights. They should keep them the cancellation to the minimum. Unresolved complaints should become, again, lower. The volume of unresolved complaints has increased in 2023. So integrating these initiatives into a holistic approach is crucial for ensuring a positive overall customer satisfaction and experience. Then we go to, so with this we come to the end of customer's perspective. Then we go to internal, which is business process and, business process improvement perspectives. So the flight operation cycle time, on ground turnaround time. So that is when a flight comes to the flight time takes off, it takes 1 hour for them. They should try to optimize it because the more flight time means the more revenue that they generate. The on the ground turnaround time should be reduced. The number of lapses of safety also becomes very, very important business perspective. That should also be reduced. The maintenance frequency rate, number of times the aircraft needs maintenance, especially higher maintenance, also becomes key. So fast turnarounds can generate more revenue. The flight safety should not be compromised. They're planning to increase the flights to 310. The passenger traffic is expected to increase. So there should be no incidents of flight safety. That should be given the highest priority. They've also mentioned that they're going to hire additional 100 staff on the ground to improve flight operations. This will also be helping them improve their business operations. The next is digitization, helping them with online booking and check-in system. The ratio of online booking versus travel agent. This will be a very important parameter to see whether digitization is actually helping them or not. The percentage downtime on the website could be another parameter that they're looking at. So this will help them improve their operations, ensure effective, available at all times to the customers. The downtime has to be reduced. They can scale up their operations. They can deploy their staff somewhere else. This will also help them rationalize operational costs because personals can be moved to more high value, customer-facing roles. That again becomes key. Route redesign, passenger load factor. So passenger load factor in different routes can show you whether, they have to redesign their routes. Is there any particular route where passengers are not preferring, or where there's a higher passenger load that you can afford, add one more aircraft, the number of routes expected to be withdrawn, which are loss-making, the number of new routes which I can add, the number of load factor for these new routes, the time period to break even in that particular route can be other factors they can consider while they are redesigning the route. And the shortage of aircrafts and the high lease costs would also be considered while they are factoring this. This brings the end of internal business perspective. The last is learning and growth perspective. The staff motivational loyalty is very key. The staff attrition rate, the staff absenteeism, the number of days absent per employee, the employee feedback score. It's very important that the attrition rate is increased from 10% to 15%. They're also saying that there are long work hours, there is perceived low pay scale when compared to the market. They're also saying the employment engagement activities may not be as much as in other airlines. So they have to have a very diverse approach, performance-based, attractive pay, which is competitive to the market, environment where they have ample amenities for employee well-being. They should have team building activities. They should have job satisfaction, mental and physical aspects should also be considered. So these are some key learning attributes. The other would be functional excellence and leadership skills. So number of trainings per ground staff, number of training programs. So you have a strategic skill ratio, better trained staff who are multi-skilled, who can do multiple things, reduce the number of minutes that the plane stays on the ground, tie up with institutes to have better trainings in aviation and other programs. So it's also given that you have 2 goals with corresponding performance measures are sufficient. The others have been included only to ensure comprehensive coverage. So this is from your exam perspective. Okay, now we'll quickly go to the other aspects of the question. Okay. So we saw that Mr. K.B. Chakraborty had been appointed as a casual vacancy director. On 19th October, Mr. K.B. resigned after working for 45 days as a director. The board wishes to fill up the said vacancy by appointing Mr. Stephen in the capacity of an independent director in the forthcoming board meeting. The board meeting is scheduled on 31st December 2023. So on 19th October, he was appointed, I think, sometime in September. Check. So on 3rd September, he was appointed as a casual vacancy director after somebody passed away. So he was appointed as a casual vacancy director on 3rd September. And again on 19th September, within just 15 days, 45 days, he resigned. And 45 days, yes, he resigned. And the board wants to fill up this vacancy by appointing Mr. Stephen in the capacity of an independent director in the next board meeting. The board meeting is scheduled for 31st December 2023. So, advise the board, keeping in view the provisions of Companies Act 2013, the appointment of Mr. Stephen, find the maximum time period within which the proposed appointment of Mr. Stephen can be made in the company. Right? I'll give you 2 minutes. 8:38, 8:40. We will go to the answer. If you want, I can show you the relevant sections, so you can answer. Would that be something that you're looking at the relevant sections of the Companies Act?
Yes, ma'am. That would be helpful.
Okay, perfect. I have that here. So this is 161. I don't know. Just a second. Okay. So 161.4 says, if the office of any director appointed by the company in the general meeting is vacated before his term or office expires in normal course, the resulting casual vacancy may, in default of and subject to regulations of the articles of the company, be filled by the board of directors at a meeting of the board, which shall be subsequently approved by the members in the immediate next general meeting. Right? I will read this again. If the office of a director appointed by the company in a general meeting, is vacated before his term expires, the resulting casual vacancy, as subject to the articles of the association, be filled by the board of directors in the board meeting, which shall be subsequently approved by the members in the immediate next general meeting. Okay, and then there's something about intermittent vacancy. Provide any intermittent vacancy of independent director shall be filled up by the board at the earliest, but not later than the immediate next board meeting, or 3 months from the date of such vacancy, whichever is later. Any intermittent vacancy of an independent director shall be filled up by the board at the earliest, but not later than immediate next board meeting or 3 months from the date of such vacancy, whichever is later. Okay, very important that there's a difference between casual vacancy and intermittent vacancy. I will give you a minute to read it through and then we will go to the answer. I mean, a minute to process and then we'll go to the answer. In a minute, I will take you the answer. We already saw the relevant provisions. So 164(1) of the Companies Act provides that if an office of a director appointed by the company in the general meeting, very, very important that if it's a director appointed by the company in the general meeting is vacated before his term expires, the casual vacancy shall be subject to the articles of association permitting it, be filled up by the board of directors in the next meeting of the board, shall be subsequently approved by the members in the immediate next general meeting. So the board of directors may fill it in their meeting and then it has to be subsequently approved by the members in the immediate next general meeting. This is what it says about casual vacancy, which is arising because a director who resigns who is vacated before his term expires or in the normal course of course. Provided any person who so appointed shall hold office only up to the date. So this is also there in the act. I just didn't read it out to you. So provided that alternate director shall not hold office for a period longer than permissible to a director in whose place he's been appointed and shall vacate the office when the director in such place would have been appointed returns to India when the term is determined. Just a second. That's it. I think yes. Alternate director shall not hold office for a period longer than permissible for the director in whose place he has been appointed. Right? Provided further that an alternate director shall not hold office for a period longer than permissible for the director in whose place he has been appointed. So that's what it says. Shall hold office only up to the date in which the director in whose place has been appointed would have held office if he had not been vacated. That's what 164(1) says. In view of the above provisions, the appointment of KB Chakrabarti in the place of so and so was valid. Right? So Mr. KB Chakrabarti was appointed in the as casual vacancy director. He's already mentioned the question that he was appointed in the as casual vacancy. In the normal course, he would have held his office up to the date in which Mr. Rai would have held the same. So ideally, he would have held the office till Mr. Rai would have held the office. However, he resigned on 19th October 2023. And again, a vacancy has arisen in the office of the director owing to resignation of Mr. K.V. Chakravarti. So the board, the vacancy arising on the board due to vacation of officer by the director appointed to fill a casual vacancy does not create another casual vacancy because 161(1) clearly says that such vacancy shall be created by the vacation of an officer who's been appointed by the company in a general meeting. It's very, very clear that 164(1) clearly says says if the office of any director appointed in general meetings vacated before the term expires, it is if the office of any director appointed by the company in a general meeting is vacated before his term. So what it clearly says. I think I read out the upper one. I think I should be reading out this, provided the person so appointed shall hold office only until the director in which he would appointed, he would have held office if he had not been vacated. I think I should have read that. I think I only read it above because of this screen issue. But yeah. Yes, correct. You're right. So if the office of director appointed in the company in the general meeting, then 164 will applies. Otherwise, intermittent vacancy is created. That's what he's also saying here. Just a second. So the board cannot fill the vacancy arising from resignation of Mr. K.V. Chakravarti, who was appointed to fill the casual vacancy. He himself was appointed to fill the casual vacancy. So he cannot be appointed just like that as per 161.4. So here the vacancy caused by the resignation of K.V. Chakravarti will result in an intermittent vacancy. And this will have to be filled by Rule 4 of the Companies Act, read with 144.9 of the Companies Act 2013. So essentially summarizing what we already said, the board may appoint Mr. Stephen either as an independent director or as a non-independent director, as an additional director under 161.1, provided the Articles of Association authorize the board to do so. He will hold office up to the next AGM or the last date on which AGM should have been held. His appointment can be regularized in subsequent general meeting pursuant to Section 149, the relevant provisions of the Act. However, where there's an intermittent vacancy of an independent director, it shall be filled up by the board at the earliest, but not later than. So very important that as an additional director, the intermittent vacancy of an independent director shall be filled up by the board at the earliest, but not later than the immediate next board meeting or 3 months from the vacancy, date of such vacancy, whichever is later. So here, Mr. K.V. Chakravarti resigned on 19th of October. Ready? Just a second. Let's check the question. Yes, on 19th of October 2023, he resigned. So 3 months from then, or the date of the next board meeting. The next board meeting is 31st December 2023. Or 3 months from this date, which should be sometime in Jan 2024. So this, whichever is later, it says. Let me just go to the answer. So the board will fill up the vacancy by appointing Mr. Stephen in the capacity of independent director within 3 months from the date of such vacancy, that is 18th January 2024, or immediate next board meeting, whichever is later. So the whichever later would be January 2024, 18th January 2024, which is what we read here in 4.1. Which is what we read here. At the earliest, but not later than the immediate next board meeting or 3 months from the day of such vacancy, whichever is later, which is what we read here. Right? Yes. Perfect. Thank you. Thank you so much. Thank you. Okay, we'll go to the last question for the day. So to recognize ticket sales from KG Airlines operates, you are required to set the following. Determine the transaction price of KG Airlines in the given case study as per IND-AS 115. How should it recognize revenue of the tickets related to the scheduled future flights? And then as KG have to pay GST on airport levies such as user development fee, passenger fee collected from the passengers, which we discussed. Thus, KG Airline have to pay GST on the collection charge of ₹5 charged to the collection service provided by the airline to the airport operators, which we discussed. I'll probably give you a minute and then 2 minutes maybe. Ma'am, how to use the notes and assignment given in the ICAI? How to use the notes and assignments given in ICAI to the case studies are also provided. Notes meaning my notes? I don't understand. Rekha? No, those which are provided in ICAI. How to use the notes and assignments given in ICAI where the case study is also provided. Ma'am, those which are provided in the ICAI. Is there somebody from the technical team who can, below the case study itself? Is there somebody from the technical team who can answer this, please? Or you can unmute yourself. I'm not able to understand what you're saying. Is there somebody from the technical team who's there, please? We'll probably circle back to this once we finish this case study. Is that okay, Rekha? Nice. So I will give you a minute. One more minute. I'm going to quickly go to the answer. I've just asked you a question to. Thank you. Perfect. Sanjay, perfect. 9505. GST is not part of it. Perfect. Right. You're right. Let's put unmute and ask a query. We'll probably circle back to this, but anyways, I've escalated to an ICAI staff because this doesn't fall under my purview. So I'll get somebody from ICAI to. I'm just a technical. Just a second. No, not got any answer yet. Oh, you're asking, is it sufficient to practice all these case studies? I don't think you'll be directly getting the case studies which are given the study material. That defeats the purpose of having an exam. You may refer some additional questions as well. Absolutely. I think that is definitely something that you would have to do. ICAI is coming up with, I think it's already released the second set of questions. What I will do is I will share the link where they have uploaded all this information. And I think I will ask them to send it to you. The link where all these practice questions, I think 50 case studies are there in this particular material that you see. So there's an additional case digest that's been published by ICAI recently, which has recently come up with additional questions. I think this is all going to help you collectively. These are the kind of questions that you're going to be getting. This may not be the exact questions that you're getting, but it's definitely sufficient to practice all these case studies which are provided by ICAI because it's very, very comprehensive. There is, I think they've covered every topic that you have studied, but you may not be getting this exact question, but definitely all these case studies, these will form the core. So, for example, like we discussed today, some of these questions, there could be a question on, evaluate GST on this particular case. Something which could be similar using the principles that we've already studied, for example, the pure agent concept that we've studied, but may not be exactly the same civil aviation question that may come. Yeah. I hope that answers your question. What all books we should carry to the exam center? I will do something. I will list it down and I will send you I will ask Mr. Deepak to upload it in your portal. I have a list which I used. So I will make a list and I will send it to Mr. Deepak. Is that okay? He has some portal where he can upload it, right? I will ask him to upload it there. Perfect. I'll do that. Thank you. Okay. So we'll quickly go to the last question, determine the transaction price. So transaction price, you will have to recognize less of discount because you're going to give the discount to the customer itself. The net fare will be 9,500 rupees. You will have GST of 5%, which is 475 rupees. You will not be recognizing output GST because you will have to pay to the government. You will also have to collect aviation security fee and user development fee because it's clearly mentioned in the question that in the ticket, you will have to collect these fees along with the ticket fare. So total amount that you collect from the passengers will be 10,725, but the amount of revenue that you will be recognizing will be an additional 5 rupees of collection charges that you are charging for collecting these two. So that you will be recovering from the airport operator. So total fee that you will be collecting will be 9,505. Let's quickly read the answer itself. Just a second. So revenue recognition will be based on Ind AS 150. It states that the entity should consider the terms of the contract, customary business practices to determine the transaction price, the amount of consideration that they expect to collect in exchange for transferring the promised goods or service to the customer, excluding amounts collected on behalf of third parties. So it's very clearly stated that they've excluded the amounts which are to be collected based from third parties, which is basically your aviation security fee and user development fee. So these are not economic benefits that flow to the entity. They are excluded from revenue. That's why you should not be recognizing revenues. Even though you're collecting it, you should be directly transferring it. It should not be a revenue that you're recognizing in the financial statements just because you're collecting it on behalf of a third party. So it's very, very clear that this is not your revenue. This is something that you're collecting as an agent for somebody else. So therefore, it should not be considered as a revenue under Ind AS 115. As per Ind AS 115, each booking is a contract that the passenger enters into with KG Airlines. So I think this should be something that you should be doing after you've studied everything, because there's going to be a collation of everything that you've studied. So I would, if it were me, I would say that, of course, this is, maybe after you finish a couple of chapters, you can go through these case studies. You can go through, how I would approach it is, if I finish studying GST, I'll go to the case study, I'll control F GST. I will see all questions which are related to GST, see if I'm able to answer it. So it'll also give me, double the practice to see if I'm good with, if I fully studied indirect tax, and if I'm also able to answer these questions. So, for example, that's how I would approach it. I will have a look at all these questions to ensure that, I'm able to, so essentially say it side by side, but I don't think this can be done in isolation. You will not be able to answer a full case study by yourself if you've not studied the other aspects. But one good amazing thing is you have, you can always refer to a lot of study material. Because you will have access to a lot of books and information when you go into the exam itself. So my recommendation would be that after you read a particular chapter, go through the case study, see all the questions, sub questions which are relating to GST, try to solve it. In that way, you would have essentially covered everything once. And then once after finally you can come back to this and read it. That would be my approach to this. Again, it could differ from person to person, but my approach would be that. To do this concurrently, but also in a way. I have question: 5 rupees earned for commission from governments, the revenue from operations, as a revenue from other income. Perfect. So I think, okay, that's a very, very good question. Yes. So just a second. You're talking about the collection fee, right? I hope that you're talking about the collection fee. You're talking about collection fee, right? This is not to the government. This is to the airport operator. So it's earned as a commission to the airport operator, because you're collecting the UDF from him. It's for him. But yes, this will be under other operating revenue essentially, because this is part of my core activities, right? This is not a non-core activity for me. This becomes a core activity. Every time that I'm charging, so that's why it will not be other income, it will be other operating income. That's the difference between other income and other operating income. Other income could be your scrap sales. Other income could be your strategy for this subject. Have you done one case study each day or some other way? Okay. Okay. So my strategy for this would be, if I'm being very honest, I didn't have this when I was doing my CA. But if I had, we had something called something slightly like this, which was an optional paper. But we didn't exactly have this when I studied back in 2018. This was the IBS. It's fantastic that you guys have it right now, because it's going to give you a very well-rounded perspective of all the topics. But my strategy would be to see, again, like I said, if I'm going through this, if I were a student, what I would do is, after I finish preparing for, say, indirect tax, I will go through the case. I'll just read the case study. Look only at the questions. I won't look at the case study itself. Only look at the questions. And if there's something relevant to GST, I will just read that GST part alone to see if I'm able to remember what I've studied in GST. Then similarly for income tax, after I finish studying income tax, I will go back and see, additional depreciation. I will try to remember, if 115BA is there, do I apply this? So that's what I would do. I will try to segment it and read it, because there's no way you can read this entire case study by yourself. Entire case study without going through other study materials. There's no accounting and other things. So what I will try to do is, once I've finished financial reporting, I will try to see what are all the Ind AS related questions. If I'm able to answer those Ind AS related questions, at least I will try to see if I am able to answer. I won't try to work it out, but I will try to see, is this something that I've studied? So that will give me a double assurance. I would have studied this case study once, plus I would have also revised on Ind AS. So it will give me a dual benefit. So how I would be going through this is trying to see what are the aspects. So trying to segmentize this instead of going through all the case study. So that's going to be a very, very time consuming exercise. If you can segmentize it and see, just look at the questions, just look at all GST questions in one go. So that will give you a confidence that you finished all GST questions which are here. That will also give you a confidence that you finished you're thorough in GST. So it will give you a dual benefit. Similarly for financial reporting, take all the Ind AS related questions, read it, and then try to solve it. That will give you again. So by that time, once you finish every chapter, you can go through this as a, see, it's like how you do it in a mock exam suggested paper, right? That's what you should be doing. So in a question paper, so after you finish a chapter, you can go back to an exam question paper and see if that question paper sum has come, whether I'm able to answer it. That's how you get assurance that you have completed that chapter successfully. Similarly, you can apply that in a broader perspective here, broader framework here. You can see questions which are related to financial reporting, try to solve those questions related to financial reporting. That will give you confidence that you have read all financial reporting. I mean, that's again, like I said, you will know that FR you are thorough, and you would have definitely covered all FR related questions. So by the end of all 5 chapters, 6 chapters that you study, after you finished law, try to attempt all law related questions. If possible, buy that book and then tag it, maybe color code it, tag it, flag it, and say these are all the law related questions. Try to attempt all the law related questions after you finish law. So that will give you confidence that you've covered all law related questions. So by doing it, you would have studied this entire case study once. Entire case study, you would have finished it once. So before your IBS exam, you can just go through it and you will already know that these are questions that you already covered. So that is how I would approach this. I don't know if this would work for you, but I think this would be the approach that I would take if I were in your shoes. That makes sense? Can you please reconfirm the list we should carry? I will send it to you. Mr. Deepak will upload it in your portal. I will definitely give the list of questions that I had referred to when this was an optional paper for us. I will definitely do it. I'll send it to Mr. Deepak. Any other question? Thank you so much. Appreciate it. So yes. So revenue from sales. So you also find that people are paying upfront for the tickets for flights that are scheduled later. So that will be recognized as unearned revenue. It will be forming part of your current liabilities. So that liability is for the entity's obligation to transfer services in the future for the consideration received today. So in that case, the liability should be measured the amount of consideration received from the customer. Thank you. Okay, so next aspect is the passenger service fee and the UDF that is being collected by the airline. So in that case, these are generally, these charges are liable to GST, but these are being levied by the airport operator and only being collected by the airlines. So these charges are being collected by the airline as an agent of the passenger, not as a consideration for any service provided by the airline. So it will fall under the pure agent rule of Rule 33 of CGST rules. Therefore, it's the airport operator who will have to pay GST and UDF on this, not the airline, because it's a service, because the revenue is being booked in the books of airport operator, not the airline. So he'll be the one who will have to pay GST for this. So he should separately indicate the amount of PSF and UDF and the GST payable on such amount by the airport operator in the invoice issued to the airline to passenger. So essentially in a ticket, you will have separate items saying airfare, the GST, and then separately what's the UDF, PSF, and the GST on it issued to the customer will have 2 different segments. One is what is charged by the airlines and the GST to be paid by the airlines. The other is what is being collected by the airlines and what is being charged, what GST is being charged on those fares. So they will also be the collection charges, like we just discussed, is a revenue that is being booked in the books of the customer. See, in the books of the airlines, it's being recognized as a collection charge in the books of the airlines. Therefore, this collection charge being a revenue, GST will definitely have to be paid. So they will be liable to pay GST in the same. The collection charge paid by the airport operator, the airlines are a consideration for the services provided by the airlines to the airport operator. They should be the airlines shall be liable to pay GST in the same. So when they're raising the bill to the airport operator, they should be charging GST in the same. That should definitely be the case. Yes. So that brings us to the end of the case study that we had planned. I think I fairly completed within time 9:04. So if you have any questions, you can probably this will be the right time to ask. I hope this was useful to you. I had a lot of fun going through the case studies. I think it's a fantastic subject as such, which gives you a very whole-rounded perspective of all these topics together. I think one of the best subjects that ICAI has brought out. It's very, very important and very interesting also. Yes. I wish you the very best. I hope you do very, very well in the exam. And yeah. Is that if there's no question from your side, no more questions from your side, I'll probably log out. Thank you so much. Thank you. Thank you so much. Wishing you the very best. Thank you so much for your active participation. Thank you. You're all very, 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 very participative and interactive. I really enjoyed having this session with you. Thank you so much. It's when you have these interactions that that makes me feel that what I'm saying today is of value, that it's actually making a difference. So thank you so much. I feel very honored and privileged to have such interactive students. Thank you so much. Thank you.
Ma'am.
Yes. Yes.
Ma'am, vote of thanks from my side. On behalf of everyone here, I would like to sincerely thank you for taking out your time from your busy schedule today. We truly appreciate the way you explain how tax laws, financial reporting regulation, and business strategies all concepts are linked together when a company wants to grow in a responsible way. Your examples made it clear that real business decisions are not about one subject alone, but about a big picture. That is exactly what the integrated business solution paper is designed to teach us, to connect knowledge from different areas and apply it in practice. Ma'am, your insights have given us clarity and confidence, and we are grateful for your guidance. Thank you so much, ma'am. Thank you so much.
Thank you so much. Thank you so much. I appreciate it. Thank you so much.
Ma'am, thank you so much, ma'am, for the
Thank you so
detailed
much.
explanation.
Thank you. Thank you so much. Really enjoyed the session. Thank you.
Students, if you have any query, please go ahead and raise your queries. Okay, then I am going to wind up this session. To all our students who joined today, thank you so much for your active participation and your valuable questions. Your interest made this session very meaningful and insightful. Keep learning, keep exploring, and most importantly, keep practicing. Wishing you all the very best. And once again, a big thank you to everyone for joining this session.
Thank you, sir.
Welcome.
So they also wanted to know the list of books that I will send it to you separately. You can probably upload it in the portal, sir.
Sorry?
List of recommended study material. I mean, list of books that they should be carrying when they go into the exam. I will just share that list with you, and you can probably upload it, no, sir?
For this, only your subject-wise study material is sufficient, and best material is your own concept notes. And best way to handle this subject is prepare the index. Okay. In examination hall, carry your index, your mind maps, your notes, and along with relevant study material. Okay. Students, any other query? Miss Chitra, Mohita, Sanjay, Saurav. Okay, Ashok ji, please wind up the session. Yes. Very good.